Hello, everyone. Welcome to the very first session of the 2025 ANZ CFO Summit. Can see a lot of you still joining, so I'll just give you a moment to trickle in. We're joining you from Sydney. It's a bit grey and overcast this morning. Feel free to drop in the chat function where you're joining us from today. Hey, Newcastle, Sydney, Brisbane, Geelong. Thank you all for taking the time out of your busy days this morning. Oh, they're flooding in. Awesome. All right. Well, we've got a tight schedule, so I'm going to jump straight in. We're thrilled to be back for our fourth year, bringing together finance leaders from across the region to share insights, spark discussions, and explore the future of the CFO role. Every year, we take on board feedback from our community to refine and elevate this event, and we hope you'll notice that through today's sessions. My name is Shauna Kenny. I'm the Senior Marketing Manager at Wheel and a community leader at the Australian CFO community. If you're not familiar with Wheel, we are the leading spend management solution in Australia, helping finance teams of all shapes and sizes to control spending and streamline their back office admin. We're very fortunate today to be hosting this session from the beautiful Gadigal lands of the Eora Nation. In the spirit of reconciliation, Wheel respectfully acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. While Wheel is the team behind this event, we couldn't do it without our wonderful sponsors. So a huge thank you to CFO Magazine, Translucent, and Fathom for making today possible. A quick reminder of house rules today. We want this session to be interactive, so feel free to ask questions. To do that, use either the chat function, which can be found at the bottom of the Zoom panel, or the QA function. I'll then pose these questions to Cherelle. Wonderful. Take a breath after all of that. We're now ready to dive in. I'm now going to hand over to the brilliant Cherelle Murphy, who is the Chief Economist of the Oceania region at EY. She'll be sharing her 2025 economic update for CFOs and finance teams. Cherelle, welcome to the ANZ CFO Summit.
Thank you very much, Shauna, and good morning to everyone. It's a real pleasure to be here, and I'm really thrilled to be invited. So I'll get stuck straight in, shall I, Shauna?
Please do, yes.
Great. Okay. The tech works here. Are we good there, Shauna? I can see our
yes, see nice and clear.
EY branding there, kind of rainbow.
Love it. Oh, if we've got the little sorry, it always happens to me. That little Great. Fabulous. We're ready.
Thank you. And so let's get stuck into it. Now, obviously, as we are looking into 2025, we can't help but notice the extremely turbulent world that we're all operating in at the moment. And I wanted to start there with particularly the trade disruption that we're seeing across the world. Now, Trump, the inauguration of Trump and his quite extreme policy choices, of course, that we've seen over the last few weeks have really caused a lot of ructions on markets. And I'll go through some of this and I'll go through some of the economics. But I did want to start out by pointing out that the sort of increase in trade distortive policies, which Trump has either put in place or is promising to do over the coming weeks and months, are, I guess, a continuation of some changes in policy that we've seen for some time. So this is not kind of an absolutely new phenomenon. And in fact, a lot of it did start back when we had Trump in office for the first time. So as you can see here on this slide, there has been an incredible increase in the number of what we'd call distortionary industrial policies across the world. This is some work that is done out of our team in London, and you can see that even just through 2023 and 24, there was that sort of fairly severe increase in policies put in place for a number of reasons. Some of them related to geopolitical concerns, others related to climate mitigation and security, strategic competitiveness. This is just a count basically of those that we've recorded. And then on the right-hand side, you can see that the new trade policies entered into since about 2018 have been overwhelmingly negative. In other words, they are shutting down global trade as opposed to opening it up. And the liberalizing policies you can see there in the white line have really been outnumbered by the harmful or distortive trade policies around the world. So in some ways, this actually explains part of what Trump is doing. He is responding to this. Now, part of them obviously were from Trump 1.0 back in those early days, as I say, but there's also been, of course, a number of more restrictive policies in place around the world, including, through Europe and, of course, through our region as well. So it's kind of a continuation of something that's already representing a kind of a deglobalization around the world, which of course we economists don't like at all, because there's of course reasons why we trade. We gain the specialization of labor, we share technology, we share knowledge, we share people and ideas, and we are making the most of the advantages which other countries have. So as we know from our Economics 101 back at uni, there are comparative advantages and absolute advantages that countries have, and by trading, we all get to share in those. So seeing the sort of global trade policy trend turn around and go backwards is really very, very disappointing. And it looks like this year, of course, that is going to accelerate to an extreme that we've not seen for really a very, very long time. So moving on to the sort of economic factors or the economic harm that has been caused by the trade war, as we have seen so far, and of course this could change as we go through the year. But it's pretty clear, and we've seen this highlighted by a number of economists around the world, and including the OECD this week, who released their major economic outlook for the year ahead. They have revised down their economic outlook across the globe, particularly for the US and those countries that are currently impacted heavily by the tariffs. And at the same time, they've lifted their inflation forecast for a lot of these countries. So it goes to the point that tariffs are bad in every way. They slow down growth and they increase price growth. So we did some modeling in EY where we looked at specific scenarios of the 25% tariff on Mexico and Canada, 10% tariff on China, with some retaliation in there. And you can see that the GDP impact is of course quite harmful for Mexico and Canada. In fact, so harmful that it would push them into recession. But it's also really bad for the US. When we get along to Australia and New Zealand, it's of course at this stage with this level of tariffs not nearly as bad. In fact, it's reasonably negligible, but as I say, we're at the start of the process. But it just shows you, I guess, how harmful these tariffs can be on a country's GDP level. When we look at the inflation impact, so same set of assumptions, 25% tariffs on Mexico and Canada and 10% tariffs on China, you can see that, again, there is a one-off hit to inflation in the US. It's not huge in the first instance, but then Mexico and Canada are being hurt much more severely. Australia and New Zealand don't see any impact from this particular set of assumptions, but they do start to see a downward force on inflation, which is actually coming from slower economic growth. So there are, as you can see, again, hit to GDP, it gets pushed down by the tariffs, and there's a one-off increase in the CPI level, which is of course pretty harmful at the moment, given we've just kind of dealt with a lot of the inflation problems. Now, it's starting to show up in some of the real data. So when we've got the theory and we can model what we think this will look like, but we're already seeing the impact in some of the actual US indicators. And this one is just from I think it was released on the weekend, actually, from the University of Michigan, showing that consumers are changing their expectations of inflation, and they've changed them pretty quickly. The expected inflation rates over the of the next year have jumped most severely. So you can see that rising from what was a very nice and comfortable low level of around about 2.6%, excuse me, up to over 4% in quite a short, excuse me again, period of time. So that, of course, is quite dangerous because inflationary expectations do tend to lead to inflation because it changes the way that consumers and businesses start to behave. They start to preempt these price rises, and businesses might be putting their prices up more to preempt what's coming. When it comes to the Federal Reserve, there has been some, I'd say probably fairly minor changes in market expectations as a result of the tariffs, but they are notable in the sense that they're going in the wrong direction. So this is, of course, just the US policy rate, the Fed funds rate. The Fed has been now lowering that for some time as it got comfortable with inflation coming down. And the dotted line is the market pricing, so expectations of where that's going. Now, the two pink lines there were taken back in the 1st of November, so just before the US election, and the 30th of January, which of course is just after inauguration. And you can see that kind of jump up to then where the blue line is, which is today's data, and it's showing that markets expect that the pace of US rate cuts slows. And as you can see, really doesn't change a lot over 2025. So again, the markets are anticipating inflation coming into the market, which the Fed will have to respond to. And the way it will respond is by not cutting rates as much as they previously thought. The consumer sentiment numbers also are starting to respond quite severely to what's going on in the US. And you can see that almost across most voters, there is a decline in sentiment. It's not nearly as bad for Republicans, but there is a little bit of a turn down, as you can see there in the most recent indicator, but a very big drop in Democratic consumer confidence. Now, again, this can translate into actual economic activity because, of course, when consumers don't feel confident and they feel worried about the economy, they're less likely to spend. Equally for business, they will start to feel a little nervous around these trends that they're seeing. And then markets, until very recently, so just a couple of weeks ago, the equity markets had been taking all the good news from the Trump administration, the deregulation, the tax cuts, everything that would push up growth and pushed up equities to record high after record high. But that, of course, has changed in the last couple of weeks, and particularly off the back of the comments from Trump almost acknowledging that there could be a recession in the US in response to his policy changes, the markets have gone the other way. So equity markets have fallen reasonably sharply in quite a short space of time. Now that is, of course, translated into markets around the world, including I've pulled out the Australian S&P index there just to give you a point of comparison. At the same time, of course, the safe haven flows like gold, and gold's one that's been getting a lot of headlines recently, have pushed up. So there is a response from the market saying, yeah, we're really not sure about what's going on here. There's a lot of uncertainty out there. Therefore, we're going to put our money into these safe assets. I'd also say, of course, that this is not just a trade story. This is very much a geopolitical story. And as the US dollar price of gold moved above $3,000 an ounce over the last couple of days, that's obviously reflecting also what's been going on in the Middle East with an abhorrent increase in the violence again there. So there's a lot of worry out there in the markets right now. For Australia and New Zealand, the impact of the tariffs, as I say, is not entirely clear yet because, yes, we've had a tariff imposed on our steel and aluminium exports, but so far that's all we've seen. Now, of course, the Trump administration at the moment is working on a fair and reciprocal plan. And in the words of the US administration, what that's doing is seeking to correct long-standing imbalances in international trade and ensure fairness across the board. So what they will do is they will look at a whole bunch of settings in other countries, and they will do this on a country by country basis, looking at direct tariff barriers, but also discriminatory and extraterritorial taxes, non-tariff barriers to trade, unfair or harmful acts, or any policies, practices, subsidies, regulatory regimes, exchange rate policies, wage suppression policies, and any practice, written or unwritten, that the administration thinks is unfair or imposes a structural impediment, of course, on the US. So it goes well beyond just those official tariffs that may be in place. And what they're going to do is, for each country, is sum these all up and calculate what looks like the impact on US business and remedy it with a return tariff. Now that is clearly a pretty complex business, but what really worries most observers of this at the moment is the definitions of unfair, unbalanced, harmful, and burdensome are not clear. These are very subjective words. And so what it will translate to in terms of tariffs is therefore unclear as well. And this goes quite deep. This is some work that has been put out by the Australian Centre for International Trade and Investment. It's a great group which looks at the current issues in trade and investment. And they pointed out that one country's burdensome is another's pharmaceutical benefit scheme. So the US doesn't like our PBS. It sees it as subsidies, and it sees it as an impediment to US business. Also, another country's unfair is one country's fruit and mouth biosecurity control. That's how deep these potential unfair categories will be examined by the US administration as they look to tariff other countries. Now, this is all likely to be wrapped up fairly soon. The president is looking for the report on this by the 1st of April. And it does seem likely, although of course nothing is very predictable at the moment, that this will be the reciprocal tariff or the tariff to remedy this will be put in place pretty quickly after that. And then from there, who knows? But it does show that there is some very direct impacts still to come. And then indirectly, of course, not only do we sort of suffer a tariff of Australian exports into the US, which is not the end of the world in the sense that the US is not our biggest trading partner. But of course, it hurts every other country that we trade with, and particularly China. And a lot of the US administration's trade restrictions that it intends to put in place, of course, are intended to hurt China. So this will, of course, flow onto us, both in Australia and New Zealand, given China is our biggest trading partner. So I think we've still got some way to go just to get an understanding of how much this will cause our GDP to be lower than otherwise and our inflation to be potentially higher. Now, this all comes at a time when we had just effectively got inflation under control globally. Headline inflation, which, as you know, grew very, very quickly in the post-COVID period because we had a bunch of supply side constraints pushing inflation higher, as well as central banks that have been stimulating their economies with very low interest rates, and fiscal policies also adding a lot of stimulus into the economy. That had started to come back down to central banks' targets around the world, and including, of course, in Australia, where we've started to see some progress, and New Zealand, where progress had been recorded actually some time ago. And central banks consequently had been lowering rates. And you can see on the right-hand side there that policy rates were sort of coming down somewhere closer to neutral. You wouldn't say that they were going into stimulatory territory, but for most economies, they were looking to take out the tightness in monetary policy that they'd put in over that 22-23 year or 2 years. Market expectations remain, as you can see from the dotted lines, that there will be a continuation of the central bank policy rate cuts over the year ahead, although, as I was pointing out with the US, the rate at which the markets expect those central bank cuts to come down has been pared back a little bit. And it's looking like we will probably see nervous central banks will be worried about the impact of tariffs on their prices. So less rate cuts, in other words. It wasn't enough, however, or the changes that we've seen from the Trump administration haven't been enough to stop entirely rate cuts from either the Australian or New Zealand central banks. So New Zealand, of course, has been cutting for some time and has continued to do so, including in 50 basis point or half percentage point moves. And in Australia, in February, we saw the first 25 basis point move. So the central bank's kind of taking everything into consideration, saying we can still afford to take out some of the tightness that was in monetary policy, but where we go from here is a little more unclear. The differences between Australia and New Zealand now start to kind of become a little more obvious, and therefore the implications for interest rates as well. In Australia, we're definitely seeing a universal expectation that the RBA is not done with its rate cuts. Of course, it's only put in place one 25 basis point move, and the cash rate has only been moved down from 4.35 to 4.1%. And when we just surveyed the economists across the markets and pulled out the Bloomberg expectations here, you can see that all forecasters expect the rates to go down again in 2025, and most expect them to potentially fall a little further too in 2026. Equally, in New Zealand, the forecasts across the market are that the current pace of rate cuts is not finished, and again, there will be more there to help continue to support that recovery that we're starting to see in the New Zealand economy. So several there putting in place rate cut expectations across 25 and 26. The differences, though, really kind of come down to the state of the activity in the two different economies. So while headline inflation has come down across both Australia and New Zealand, making both central banks much more comfortable and more likely to put in place more rate cuts, the unemployment rates are one sort of shortcut way to look at some of the differences, with New Zealand having seen quite a sharp increase in its unemployment rate since the low point in the post-COVID period, whereas in Australia, the labour market has remained much stronger and its unemployment rate has levelled out at about 4%, where it's been for the biggest part of a year, actually. So some fairly significant labour market activity still going on here in Australia, and that's clearly keeping the Reserve Bank at bay a little bit. It doesn't feel a need to quickly stimulate the economy, unlike in New Zealand, where the unemployment rate had moved up and the economy had clearly slowed down much faster in response to previous monetary policy and events. The good news, I guess, is that in both economies, there is an expectation that the economies will recover, that GDP growth will be stronger in 2025 than it has been in both 24 and 2023. This is not a particularly strong story for New Zealand. As you can see here, the blue dots there represent the forecasts from across the market. And you can see that really at most, the forecast is about 1.2% growth for 2025. So yes, it's an improvement, but it's a fairly meek one, at least for the year ahead. And in Australia, it's a little stronger. So whereas 2024 was a pretty weak year for us, with growth actually falling below the 2023 levels, by the end of 2025, most forecasters in the market, in fact, all forecasters in the market, are expecting growth to sort of be a little higher again and heading to sort of around about 2.5%. So it is a little bit of a better outlook for Australia if you believe these market forecasts. I just want to go a little bit more into the Australian story here, so forgive me for those who are only interested in New Zealand, but I think there's some interesting things going on. Whereas I think the case for lower rates in New Zealand is very, very clear, in Australia it's not so clear. And when we look at what the markets have been expecting from the cash rate over the next year to year and a half, you can see there's been quite a bit of variety over the last few months. So back in November, markets were fairly worried about the inflation ongoing. The expectations on rate cuts were fairly meek, and that you can see that in the blue dotted line. So the cash rate of 4.35% certainly was expected to be cut, but not by very much. As we went through to the beginning of December, those changes, especially as the CPI number came in quite low for the September quarter, that number fell, or those expectations of lower rates fell quite a bit. And today, after we've of course now had one rate cut, the market is expecting that the rates will move by at least sort of 50 basis points over the year ahead, and potentially a bit more into the first half of next year. That is something that the Reserve Bank Governor Michelle Bullock has said that she's not particularly comfortable with that outlook, and she thinks that the case for lower rates is not as clear as the market is projecting it to be. And just a quote straight from the board documents on the 18th of February when they made the change was, if monetary policy is eased too much and too soon, disinflation could stall and inflation would settle above the midpoint of the target range, so above that 2 to 3% target point. So in other words, they're not really quite convinced that the that inflation is under control. They're certainly moving in that direction, and they have suggested that things are going reasonably well, but whether or not things actually fall as they expect, they're not sure. And of course, the trade war to some extent plays into that. The other part of it, of course, is the labour market, because Australia's labour market has been really quite tight. And what I mean by that is, of course, a low unemployment rate. A large percentage of the population is working. In fact, record highs as a percentage of the population are working. The female participation rate has increased enormously in the post-COVID period. And of course, those kind of conditions tend to lead to higher wages, because employers find it harder to find the workers that they want and may have to bid up wages to get them. I find this quite extraordinary. On the right-hand side, it's a set of data from Jobs and Skills Australia, so this is a government department, and you can see that the proportion of firms who are saying that they are still having difficulty recruiting labour is still kind of above 50% for those looking for high-skilled labour, and around about sort of 35% for those looking for low-skilled labour. So in other words, there's a lot of employers out there still really struggling to find the people that they need, and maybe this is your experience as well. And again, that does tend to lend itself to tighter labour market conditions, which can translate into higher wages. So I think the RBA is a bit nervous that the tight labour market just means that the decline in wages, which they predict, wage growth, I should say, not wages themselves, but wage growth, may not happen. And in fact, they've got a slight increase in their forecast, as you can see there, for the wage price index on the left-hand side, that little dotted line in pink. So, they can certainly tolerate wage growth of 3.5% without it causing inflation, but I think they feel that the risk is that will not eventuate, and we might see wages push a little higher. The wages equation is not quite that simple, because it matters not only what the actual wage rates are and how they increase, but also how productive workers are. Because clearly, the more productive workers are, the more wage increases are justified, and you can have higher wages and not get an inflation response as long as you have high productivity growth. But at the moment, of course, we do not have high productivity growth at all. And so until we see that, again, the RBA are worried that tightness will translate to higher, what they call unit labour costs. So the cost of a new worker for a firm, which incorporates that concept of both wages and productivity, that's been running quite high. I guess when you kind of reverse this argument, the upside is the fact that we are able to hold down or keep the unemployment rate at these very historically low levels of about 4% without generating inflation. So maybe actually the economy has structurally changed enough such that the unemployment rate of 4% doesn't generate inflation. And I think the Reserve Bank, again, they're really toying with this. They're really thinking, well, maybe actually this is just the economy we're in now, and it's an economy that runs better and that can tolerate a tighter labour market without generating inflation. So you might have heard of the term NAIRU, which is the non-accelerating inflation rate of unemployment, quite a mouthful. But what that is the kind of the level of the unemployment rate, which will neither generate excess inflation nor take it away. And if that comes down, that's great news. It's really positive for the economy, means that more people can hold on to their jobs and we can have a low inflation environment. So why might that be? Why is that NAIRU, or non-accelerating inflation rate of unemployment, coming down? Well, it could be structural, but it could be cyclical. And again, this is where the RBA gets a little, let's just say, worried about its own analysis and what's going on. But one thing that we have seen recently, and you can see this on the right-hand side, is a very significant change in the mix of the jobs across the economy. So we've had much faster growth over the last year or so in non-market jobs compared to market jobs. So non-market jobs are basically those in the government sector, so government administration and health, education, those types of roles. For very obvious reasons, the health sector obviously is growing very strongly at the moment, and government admin has been strong too, with the government taking on a lot more public servants. And these roles don't tend to be particularly inflationary, if you like. They don't tend to come with particularly large wage rises. So that could be why you can get better jobs growth, lower unemployment, and a relatively stable and low inflation rate. And part of the reason, of course, that this non-market side of the economy, that the health, education, government admin has been rising, is simply because the government sector has been spending like crazy. And I don't even use that term loosely, because you can see here that the size of the public sector in Australia has grown enormously over the post-COVID period. Back in 2020, of course, we could explain that big spike up in what we call government consumption. That was, of course, responding directly to COVID, the need for more health spending, the need for more support for the household sector. But what we can see since then is that the level as a share of GDP, so this is not just dollars, this is as a share of GDP, is showing a sort of a strong increase even since 2020. Equally, government investment in the pink line, that has grown as a share of GDP as well. So when you add those two together, and I should just clarify, government consumption is things like public sector wages, spending on the pharmaceutical benefits scheme, the NDIA falls in there. Everything that's kind of a recurrent expenditure for the government falls into the green line. And then those more long-term investment spending decisions like roads, bridges, tunnels, defence equipment fall into the pink. When you add them together, they're now above 28% of GDP, and that is, clearly a very high level by historical standards. Basically a post-World War II high, and it's really driving what's going on in the economy. So, more than $1 in every $4 that's being spent in the economy right now is because a government, whether state, federal, or local, is spending it. So that, of course, does start to explain why the health sector, the education sector, and public admin employment is so strong. The bad news, though, is that the outlook for GDP, although it is certainly a bit better, and we could get to sort of about 2.5% growth, it remains fairly mild. And even though that we've got a relatively strong labour market, we're just not seeing an awful lot of growth in the economy. And that's in part because although that government sector is strong, the private sector is much weaker. Business investment in particular has been fairly low and stable as a share of GDP now for almost 10 years, really. It's been hanging around below 13% of GDP, which, as you can see by historical standards, is really quite low. Now, obviously, the mining boom back in the sort of decade or two before that drove those numbers a lot higher. but we've just not been able to recover that. And that, of course, is not a great sign for an economy which really needs to grow a little faster and have stronger productivity growth. Productivity growth often comes from investment, of course. It's investment in IT equipment or new capital equipment. And none of those things are really happening in a big way at the moment. There are, of course, some exceptions to this. We think about what's going on in the renewables sector, where there is certainly a lot of investment. And in data centers, it's another area where there's investment, but it's not universal across the economy. And the productivity story in Australia and New Zealand, actually, for that matter, is just not very good at all. And we're starting to see the the US figures really stand out compared to the Australian measures. Now, there's a whole bunch of lines here, basically because the measurement issues are a bit tricky on productivity. But the bottom line, or the bottom message here, is that while the US has continued to lift its productivity growth over recent years, Australia and New Zealand are certainly not following along. And neither are many other countries, actually. The US has been a standout. Now, how the trade war affects the US is yet to be seen, but it is quite possible, of course, that sort of US exceptionalism doesn't continue in the current circumstances. But it's going to take a while before we can actually see that in the productivity data. So I just want to talk a little bit about the consumer as well, because when we sort of have looked back on the economy over the last couple of years, it's of course really it's been quite depressed from a consumption point of view. And household consumption is 50% of GDP, so it's substantial. And these data are for Australia, but the picture is not so different in New Zealand either. When we use 2019 as our starting point, we know that the inflation rate, of course, has been strong over that period, but to think about how much prices have increased over that period just shows us why cost of living is such a big issue in Australia and New Zealand. So insurance costs 46% higher since 2029. The cost of building a new home 40% higher. Cost of fuel 27% higher. Education 20% higher. Food prices, essentials here 24% higher. Rents 17.5% higher. One of the few categories to go down is electricity, and that's of course just because of the government subsidies. And as soon as they come out of the equation, that all just bounce back up again. Although of course it looks like there's a lot of the subsidies will be continued in the budget. So there is an ongoing cost of living issue in these economies, which is still continuing to keep consumption quite low. When we look at the most important factors in the federal election, and this is a survey from Newgate, cost of living just is a complete standout as something that's really affecting voters' thinking as they go into the election. So I'll just wrap up I can see, Shauna, you're winding me up here. I just wanted to wrap up by touching on the budget, because obviously this is going to be in our headlines over the next week or so, even although the government was clearly not planning on issuing a budget and instead wanted to go straight to an election until Cyclone Alfred changed everything. So therefore, I think we can expect a few things. One is a continuation of some pretty bad fiscal numbers. In other words, we will continue to see the government spending way more than it's bringing in, and the policies that we're likely to see are the election sweeteners, such as the electricity rebates, are just really not affordable at all right now, unfortunately. So it's not going to be a pretty picture. I don't think it's really going to play very well for the government as we go into the election period. The big picture issues, of course, related to this fiscal management are much more related to how we're collecting tax and spending it. And the fact that we have these very strong growth in a lot of our spending programs means we really need to be rethinking how we're doing the revenue side. And I have a whole different presentation on that, Shauna, but I will stop there, and more than happy to take any questions and, of course, talk about any of these individual issues with those on the call.
Thank you, Cheryl. Cherelle, sorry, we'll have to get you back. We are at time. I guess it would be great to just to leave us with what you're most optimistic about in 2025. Let's end on a positive note.
Yeah, how about I try my camera, but if it causes any problems, I'll turn it off again. So mostly optimistic about the fact that the economy's really settled down a lot. So the inflation problems have mostly gone away. The labor market's really good. You know, that means that most people who want a job have one. You know, people can afford their mortgages. They're going to get a rate cut. They're going to feel a little bit better as the year goes on. There are some industries which are clearly doing well right now and presumably will continue to for some time. So when we look at the superannuation sector, for example, right, lots of positive news there. The size of the sector is growing. There's a lot of interest there. They're very active. They're a strong source of stimulus for many parts of the economy, actually. Although, unfortunately, of course, a lot of our super money is having to flow offshore because there's so much of it. The defense sector, clearly that is something where there's going to be a lot more spending. And while that may or may not be great in terms of, you know, your kind of ideology, it certainly does create a lot of flow down and multiplier effects in the economy. It can be very good for boosting tech and innovation, as well as, you know, the more kind of tangible parts, I guess, of defense. So those are two sectors that look really good. Yeah, health sector continues to look like a really strong area for growth. And the fact that we've, you know, been able to create so many more jobs has made a huge difference to a lot of people's lifestyles, including particularly women who've been able to combine work and family, working from home, and you know that is genuinely kind of changing people's lifestyles and their wealth. So definitely not all bad news, although
No.
a lot of it feels like it at the moment.
Yeah, it can be a bit overwhelming, but no, that's nice to end on a positive note. Thank you so much again for opening the ANZ CFO Summit. Next up, we have Michael Wood, founder of Translucent. He'll be walking us through the latest AI tools for finance leaders. And we also have Andy Watt, who's the CEO of Nearmap. He'll be stepping us through his career journey from CFO to CEO and sharing some leadership advice. So thank you so much for joining us this morning, and we hope to see you on the other sessions today. Thanks again.